On the 2nd of February, the landmark Dasgupta review was published, which revealed the devastating cost to nature of our economic decision-making. Commissioned by the UK government and led by Cambridge economist Professor Sir Partha Dasgupta, the report revealed the blind spot in economic thought and its engagement with nature is endangering the prosperity of current and future generations. The finance industry seems to be waking up to the reality of the dire climate emergency, and last month both Jupiter Fund Management and Scottish Widows have committed to net zero emissions across their combined £226 billion AUM by 2050. M&G has also made a commitment to responsible finance, announcing a £5 billion mandate to invest in privately owned enterprises working to create a more sustainable world, while Aviva Investors warned 30 of its high carbon emitting investee companies that it would divest if they do not establish robust transition maps. A survey from Core Data found that 73% of UK fund buyers believe all investment funds will incorporate ESG in 5 years, making it harder than ever to avoid both greenwashing and the green bubble. In the first of a new series of interviews with sustainable investment leaders, Ellie Duncan spoke to Hortense Bioy, Morningstar's Global Director of Sustainable Research, on how to do just that. For this month's sector focus, we turn to the world's second largest economy and the only major economy to grow during 2020, China. The world's largest carbon emitter, fossil fuels account for 85% of the nation's energy mix, although this is set to change drastically with President Xi working on his commitment to make China carbon neutral by 2060. It is already the world's largest battery manufacturer and produces over 70% of the planet's solar panels, half of its electric vehicles and a third of its wind power. While the Eastern Powerhouse has become a bipartisan issue in the US, its climate commitment should provide common ground with the Biden administration, Lion Trust's Ruth Chambers said, which would offer related companies many benefits. A tightening of monetary policy could see the pace of GDP growth slow from its exceptional rate over the past decade, as high household debt levels coupled with a strenuous fiscal budget may result in a slowed credit growth, according to Morgan Stanley IM's Gary Chung. This view was supported by Rathbone's Ed Smith, who also pointed to a shift from encouraging appreciation of the renminbi, which is up around 7% against the dollar since the start of 2020. Despite this, the industry remains positive on the prospects for China. In a shock to the industry, perhaps by timing more than inevitability, Neil Woodford is back. Maybe. On the 13th of February, The Telegraph published an interview with the disgraced manager in which he announced a new investment firm, attacked his ACD Link Fund Solutions again, and took the blame only for 2 years of underperformance, leaving the rest at various parties' feet. Within days, the Financial Conduct Authority had issued a late-night statement saying the manager had yet to prove his readiness to comply with the new standards. The Jersey Financial Services Commission announced it was disappointed to hear about the planned firm through an interview, and Gina Miller called for an independent inquiry into the collapse of Woodford Investment Management, arguing the public was losing faith in the FCA. Lee Day, which is representing investors in one of the many legal cases surrounding 2019's fallout, even suggested the interview itself could be evidence of mismanagement. Disappointment, surprise, insult and confusion were all words that featured prominently in the industry's reaction to the not quite prodigal manager, who remains under investigation and has had his latest proposal described as concerning by the Treasury Select Committee. At the heart of this frustration lies the thousands of retail investors who are left to wait and see what portion of their savings they might get back in future distributions, to whom the lack of contrition from their former manager has come as no comfort. As Miller wrote in her open letter, lessons must be learned to avoid the habitual and depressing repetition of such scandals. CEO of Amundi, Yves Perrier, stepped down after more than a decade in the role to become chair of the board, while Valérie Baudson, current head of ETFs at the firm, takes on the chief exec role. BlackRock's 23-year veteran David Tovey will leave the firm on the 2nd of April, with his co-manager position alongside Stefan Gries on the European Absolute Return and Alpha funds filled by freshly promoted Stephanie Bothwell, while Neil Gaskell's open chair on the Martin Currie Global Portfolio Trust was taken by non-executive director Gillian Watson. Charles Stanley has turned former global head of fixed income at Aviva Investors to lead its investment house in a newly created role for Dan James, who becomes head of asset management. JP Morgan hired former MP and Shadow Business Secretary Chuka Ramuna to head up its ESG work in EMEA, while River and Mercantile appointed Roger Lewis from Carbon Intelligence as its group head of ESG, and Chelverton Asset Management found a new responsible investment manager in Sally Clifton, who it hired from Quilter Investors. Lion Trust continued to strengthen its multi-asset offering post-Architas acquisition and hired MGIM stalwart James Clemster, while Monica Dutt returned to Morningstar after 2.5 years at Vanguard to head up its ETF research, and Manoj Mistry, former head of ETFs at DWS and part of the team that launched Europe's first ETF back in 2000, has emerged as Han ETF's Chief Operating Officer. Finally, Alex Brazier takes a career break from the Bank of England after more than 2 decades, leaving an opening on the Financial Policy Committee. February was bookended by studies which highlighted the snowy peaks of industry, with Green Park's annual Business Leaders Index recording no black chairs, CEOs or CFOs in the FTSE 100 for the first time since it began running its reports in 2014. Later that month, a report from Company Matters found that 96% of alternative investment market and 95% of FTSE Small Cap 100 directors identify as white, and 84% and 78% of companies in those respective indices have all white boards. Chuka Ramuna called out the Investment Association for its lack of diversity on its board after it urged companies to reflect the diversity of modern-day Britain. The IA responded saying it was committed to appointing one racially and ethnically diverse board member by 2024. Steps do continue to be made to address this imbalance, and in a month that began with the inaugural Race Equality Week, City Hive founder Bev Shah launched the second year of a cross-company mentoring scheme. This year, the City Hive scheme is being supported by Talk About Black and has been extended to both women and people of ethnic minorities, with people of all backgrounds strongly encouraged to participate as mentors. A new leadership programme has also been launched by Black Women in Asset Management to accelerate the promotion of Black women to the C-suite through a 6-month course. And IW editor Lauren Mason spoke to BMO GAM's Philip Fielding, HSBC GAM's Tim Roberts and Amundi's Ashley Fagan about the need for disability to become a much bigger part of the diversity and inclusion conversation.